Perfect. All right. Should we start the meeting? All right, great. Welcome, everyone. Welcome, two of you. Um, let's start with the approval of the minutes. Is there a motion to approve?
I move.
Is there a second? All right, Josephine. Is there any discussion, changes, anything? Nope. All in favor?
Aye.
Any opposed? Excellent. All right, since we have a big agenda, which one is going to come up and talk? I know, I'm joking. And by the way, just so you guys are aware, we don't really go over a lot of the nitty gritty, the information in the front part. We always do that. If you have questions to ask, because we're all sort of in the investment world and don't need a refresher course. And actually, the whole report is pretty much bogus because the markets did so much in April, it's sort of irrelevant talking
Yeah.
about March 31st numbers.
Exactly.
So
Yeah.
you can sort of do what you want,
This will
but
be quick for me.
well, yeah, no, I mean, I was looking at it because the S&P 500 was down on March 31st in your report, and now it's up down 4%. Now it's up 8. So that's a 12-point delta, a 1,200-point delta.
Yeah.
Right.
Yeah.
So base
Yeah,
point, right.
We did some back of the napkin math and got you an April and year-to-date return, but it's just not in the report.
I understand.
obviously.
Well, you could talk about
Yeah.
that if you want.
Yeah.
Well, sure. Yeah.
Yeah, we'll
So
get to it.
anyway,
Forget all the bad stuff and focus
yeah.
on the.
So I mean, so anyway, I just wanted to preface
Mhm.
that
Yeah, sure.
yeah, you don't have to bore us with too much of the
No, yeah.
331 stuff.
Yeah, we'll be brief.
That's fine.
So, as you scroll to Exhibit 1, that's where the performance is, and Jonathan will run through that. So, obviously, saw a huge rebound, and obviously markets have been kind of, I guess, more focused on earnings, which is what markets, I guess, should look through, hopefully shorter term geopolitical things here. But obviously we're coming off a very strong quarter from an earnings standpoint. So despite everything going on in the world, we are powering through that. And obviously, this is not money we're socking away for a vacation in 3 months. This is perpetuity, hopefully. We'll see. So we obviously have a long-term investment focus. If markets would have been down significantly, we would have been talking to you about replenishing some of the equities and doing rebalancing. The markets took care of that. So we don't have to be adding more funds to equities. So with that, I'll pass off to Jonathan.
All right, thank you, Tom. So in Exhibit 1, you'll flip from the cover page to its page 1 in the report. This is our manager status page. We just monitor all the managers to make sure there's no issues with them. As you can see, they're status-wise, they're all in compliance, so no issues there. Flip again to page 3. I call this our snapshot page. We'll go into much more detail here than this page, but if you just had one page for 1 minute you wanted to look at and explain to someone what's going on with the plan, this would be the page to do it with. Page 4 and 5, this is detail regarding the values of all the assets and the underlying composites and investments. So on this page, you see all the underlying investments, what asset classes they relate to, what they started with at value-wise for the quarter, cash flows in and out, ending market values for the quarter, weightings compared to the total value of the fund, and then what their target weightings are, what you're trying to maintain over time. So ended the quarter with $24,281,185. And as you go to the right of that number and down the page, you'll see the weightings compared to the targets for all your asset class composites are pretty close to targets, so no issues there. Page 6 shows how the plan looks like from an asset allocation perspective compared to other public defined benefit plans. This is just a reference point. Not a ton of information here that's useful to us, but just shows how you look compared to other plans in your universe. Page 7 is how the plan has changed from an asset allocation perspective over time. This is going back 5 years. Again, just flip to page 8. I will spend a moment here. This shows how the plan's value has fluctuated over the last 10 years on the top of the page. Bottom of the page is what we call a summary of cash flow. So it shows you varying time frames, what the value was at the start of the time frame, what was the cash flows in and out, what was the overall investment change for that time frame, and how we arrived at the current ending market value for Q1 2026. So over time, you see negative cash flow out, but it's a mature plan. That's to be expected. Thankfully, over most of these time frames, investment returns have more than made up for that negative cash flow. Page 9 is a look at all the different composite returns. This is repeated in later pages, so I'll just go ahead and skip past that. Page 10 shows the total fund return on a graphical basis. Page 11 is calendar year returns, so we won't waste any time there. So on to page 12, I will spend a little bit of time here. And these are annualized returns, all net of fees. You see 1 month all the way back to that SI, which is since inception. And you'll see to the right of that what the inception date was for varying investments and composites. So focus on the quarter, just to show where we were. You know, obviously it's been negated, as you mentioned, Ted, but did outperform for the quarter, thankfully. So you held your ground. You only returned negative 0.8% versus your benchmark of -1. And that 39 number there is the 39th percentile. It means you're in the top 39% of your universe. Going back ahead for 1 year, just slightly ranked high. 3 years, 5 years, and 7 years in line with your benchmark. Rankings more toward the middle. 10 years, a little bit ahead, ranked in the middle. And then since inception, underperformed and ranked low in the universe. But I will mention that goes back to 2003. So that's quite a long time frame. Underlying, we'll start with the fixed income composite. Overall returns there have been positive, and you've ranked high there. Looking under the hood for that composite, you have principal core fixed income. That is your core manager. Overall, they've outperformed or at least been in line with the benchmark for the most part. Rankings kind of mixed. In some periods high, and then in some periods more in that middling area of 3 to 7 years, more on the low side. Principal core plus bond, this is the one that we've been shifting away from to your new manager, Baird. So there's a little bit there left at principal. We can't take it all out yet. We need to kind of do it incrementally. But you can see the returns there have not been very impressive going back the last 5 years, which is part of the reason why we made that shift. Long term, though, it is outperforming its benchmark. Baird Core Plus started in September 2025. Just slightly behind its benchmark for the quarter, ranked in the middle. Since inception, slightly behind as well, but ranked above the median. So they're not off to a bad start, but there just isn't a lot of data there yet. Next, principal high yield. This one is a little confusing because you had another principal investment that was called the principal high income investment. And then principal decided to shutter that and shift all those assets from that investment to the principal high yield fund. We actually don't mind the principal high yield fund. We do have other clients in it, and we would have preferred to be in it from the start. But because that shift occurred, there's not as much data there as we'd like. And since that shift occurred, you do see it is underperforming and ranked fairly low, but was in line with the benchmark for the quarter and ranked slightly above the median. Aristotle Pacific is your bank loan manager. They've done well, outperforming pretty much all time frames except the quarter, ranked mostly in the top 20th percent of their universe since you hired them. So they're doing a good job.
So if you look at the 1 month column for fixed income, you see a lot of negatives, and then you see that one positive. So you had equities, as Jonathan will go through, equities sold off and rates also went up. And Aristotle Pacific is your buffer on that they will ride it up. So they did what we want them to do.
Yeah, because it's floating rate debt, so it adjusts as interest rates adjust. So on page 13 is a look at your U.S. equity composite. You're all indexed here. So you have money with the Vanguard 500 index fund. That's your large cap exposure. Vanguard mid cap, which is your mid cap exposure, and the iShares Core S&P small cap, which is trying to replicate the S&P 600 index. And that's your small cap exposure. So over time, you see this has been the big thorn in the side for quite a while. That mid and small cap tilt the plan has historically had to try to achieve its target return of 7% has hurt as large caps have really dominated the market. So you see returns below the benchmark going from 1 year out to since inception, but that changed this past quarter. You see you actually outperformed. Mid and small cap actually outperformed large cap. So the large cap areas where the Magnificent Seven companies reside, and that's really what's driven returns over the last 5 years now at this point. So it is nice to see mid cap and small caps coming back, a little bit more rotation out of large caps into small caps and mid caps, and also out of growth into more value-oriented sectors. The investments themselves, ranking-wise, they're getting you the index returns. The S&P 500 index is doing just fine. Rankings are pretty high because active managers have just really had a tough time in that space. So typically, it's been in the top third of its universe. Vanguard Midcap, we actually terminated a midcap growth and value midcap fund with Vanguard and just decided to marry the two, and that's where the midcap index fund came from. Rankings more recently on the low side since inception, top third though roughly. iShares S&P 600 index that has ranked pretty high. I tell you, at the end of the fourth quarter, this looked pretty rough because there was a massive junk rally in small cap stocks, and that since has completely reversed as more of a flight to quality occurred in the first quarter. So good to see that coming back, and good to see mid and small cap kind of doing their part finally, at least for now.
As a reminder, the S&P Small Cap 600 kind of has a quality bias
Mhm.
towards it versus the Russell 2000, which is kind of the more commonly used one. So last year, the ranking for just this strategy was in the 67th percentile because of all these companies that were not necessarily making profits. Some of them weren't even making revenue, and they were up hundreds of percent last year. So this year, you see kind of a little more return to sanity. You see that ranking number much lower, which is better.
Then on to page 14. At the top, you have your non-US equity composite. This one is a bit more of a rosier picture, outperforming most timeframes except 5 years and since inception. Ranking is a lot better as well, typically in the top half of the universe except for the since inception timeframe. And the underlying there, you have your Vanguard Total International Stock Fund. That's more of a large cap oriented non-US index. And you'll notice I'll say index, but indexes in the non-US equity space typically have a very tough time replicating exactly the return for a few reasons. One, there's a lot of companies in these indexes, and two, in some cases, there is actually a gate where you can't always buy all the companies in these countries, so you can't fully replicate the index properly. So that's why you might see some variance there. But overall, it's done well, stayed pretty close to the benchmark, ranked at least at the median or above. Vanguard FTSE All World ex-US Small Cap Fund, that's just a small cap international fund. Similar story here, getting you index-like returns. Rankings are above the median in the short term. Longer term, they're a little bit more below. Vanguard Emerging Markets, this has been more of a detractor for the non-US equity composite, but it has shifted again with everything that's happened in April. Emerging markets are kind of one of the big winners in the non-US space, so I'm sure that'll change once we have the full April data. Overall, though, again, similar returns to the index. Rankings more toward the low end, though, for the emerging markets fund. Then you have real estate. It's the principal U.S. property fund is the only investment in that composite. That's doing well. It's outperforming for all time frames. Was in line for the quarter. Overall, though, real estate, it had a pretty tough time, 2022 through mid 2024. It has since turned around. It's had 6 consecutive positive quarters of returns. Before that, it had troughed. So good to see it coming back. And most likely we'll continue to see positive returns going forward. At least that's what history has told us. Whenever you've had a huge drawdown in real estate, it tends to be positive for the next decade or so. And then you have your private equity composite, just one manager here as well, Partners Group, private equity fund. So it's an open-ended private equity fund. You can request money out or you can put it in. It's not what most people are used to when they hear about private equity, where you give them money and it's shut until they give it back to you. Long term, it's a little tricky to do this because it's always lagged. We're missing the March statement, I know, for this, and the index we did not have as well for Q1. So take these returns versus the benchmark with a grain of salt, but long term, you do see 6.2 versus 2.8% for the benchmark. So long term, it's done well. More recently, slightly lagging the benchmark, at least with the data that we have. Below that, cash composite, you have a little bit of cash at Regions, and by cash I mean a money market. That has had great returns, but we tend to not keep a lot of cash on hand because we're trying to achieve a certain rate of return, so we don't want to keep keep too much there and have a major cash drag on the portfolio. With that, we have a bunch of calendar year returns, which I won't delve into, and some risk statistics as well, which we won't delve into. I will take a moment on page 20. This is what we call the quadrant chart. And what this does is it compares it shows you the plan from a risk return perspective, and this is going back 5 years. So the plan is the blue square on the page, the benchmark is the black diamond, the crosshairs is the median of the universe, and all those little dots all over the page are other public defined benefit plans. So you see you're in the bottom left quadrant, meaning you have less return than the median of the universe, but less risk. Compared to the benchmark, you're right in line with the benchmark, but with less risk. We like over time to see that drift up toward the top left quadrant. So we're in a good place from a risk perspective. We just want to see that return elevate a little bit more, and hopefully with all the changes we've made recently, we'll see that start to drift upward in that quadrant chart. And lastly, on the quarterly report, on page 21, we always like to look at the plan from a fee perspective as well. So we look at all the fee schedules for your managers, estimate what you're paying them on an annual basis, just based on the information we had at the end of the quarter. We estimate that you're paying all your investment managers about $86,842 annually. That equates to an expense ratio of 36 basis points and is in line with the industry median of 36 basis points. So right in line. We'd like to see I get a bit lower, but you can see where the fees are higher is on the principal end of things, and I know we've talked about that in the past. And then on the very bottom of the page, just for transparency purposes, we put down our fee, Marquette's fee, as well as the custodial fee. After that, there's some benchmark information and what I call characteristics pages for underlying investments. Just for sake of time, we don't tend to go into those. But with that, I'll open it up for any questions on the first quarter report. All right. Without further ado, we'll get to Exhibit 2, and this one's only a 2-page deal. So every quarter, we always like to come in with recent values. So you'll notice at the top of the page it says 4/30/26. So what we did is we took all the real-time values that we could and put them down and aggregated them. So you'll see on the bottom of the page there a total plan value of 25 million and 25.5 million. Let's say it's off by a couple thousand, but you can see quite the reversal from where we were at the end of March. At the end of March, we were at 24.3 million roughly. And just to give you an estimate on return, we estimate that the plan returned 5% in April. Don't have the benchmark to compare to for that. Year to date means we have an estimate of about 4.2% return through the end of April. So that's not finalized, of course. We have some other investments that are a little bit more lagged, but a good reversal, and you're actually higher than where you were at to start the year. And you'll notice third column from the left, it says current mix. That's the current weighting of different investments and composites in the portfolio compared to the total value of the fund. You'll notice we're overweight in equities, underweight fixed income. So we always typically come in and we replenish your fixed income portfolio from equities, because typically equities are up. That's usually the source for cash. So I'll get into more detail, but recommending we take $400,000 out of equities and put $400,000 into into fixed income. And more specifically, where that'll come from is $110,000 from the Vanguard S&P 500 Index Fund, $40,000 from the Vanguard Mid Cap Fund, $85,000 from the Small Cap Fund, $65,000 from Vanguard Total International, $30,000 from Vanguard Emerging Markets, $70,000 from International Small Cap, and $100,000 from Principal Core Plus Fixed Income, and that will all get funneled to the Principal Core Fixed Income investment, because that is the account that you guys use to pay benefits and expenses. So that tends to wind down as the quarter drags on. We have to come back in and just top it up.
Do we need?
You don't technically need to, but the way it draws down, it will
Mhm.
most likely be below target at the next meeting
Okay.
anyways. So we kind of top it up a little more than we have to.
Okay.
Make a motion.
Sure. Does it, yeah, go ahead and make a motion.
I move that we accept the recommended changes to the allocations as stated.
Is there a second? Just me? Great. Discussion, questions? Anybody? All right, all in favor?
Aye.
Any opposed? Great, thank you.
Just one more thing.
And I will correct you on one thing.
Mhm.
All right.
The beginning value of the fund was 24.9.
Oh yeah, sorry. I meant, well, I had it in my mind, but you are higher than that now. That's what I meant.
Yeah, so we're not back there yet. If Darren would stop sending the money out, we would,
Oh, we're at 25 and a half,
25
end of
and a half
April.
now.
are we?
Yeah,
Yep.
look
Oh,
at
I'm
the
sorry,
graphic
my
rather
bad.
than-
Okay, you're right. I messed up.
Hey, no worries.
I was looking at that 24.5.
Usually we don't
Yeah.
focus on
You're right.
a thing
You're
like
right.
that happened in April, but
My bad.
all good. And we had one more thing. The very, very last page, we call it the benefit index page. And we do this on a monthly basis, and we always bring in the most recent one for the meeting. This just shows you there's a calculation that occurs on the principal platform because you're in that annuity. You have to keep a certain amount of money there. So we just make sure we're not breaching that level where they'd say, hey, you need to send some more money our way. So we're keeping a cushion of about between 1.1 and 1.2 million dollars. We do our own calculation and we also get their calculation. So we just kind of take the median there. But overall, we've been trying to keep about a cushion of about $1 million. We've taken a lot recently to funnel from the Principal Core Plus fixed income account to the new Manager Baird. So we've done that the last couple quarters. We figured let's just give it a break with all the volatility that's occurred the last couple months. If that drifts upward, we'll come back in next quarter and recommend we funnel some more out to Baird from the Core Plus principal account.
Do you understand?
So you got about 993,000 in that. The liquidity volatility factor, whatever, is 95% of that. So each dollar you take out is almost a 1-to-1.
Mhm.
So just keep monitoring. Eventually we'll take more and
Yep.
keep you going the right way.
Yeah, I know. I know. Great,
We'll get there.
super. All right. Wow. Do we have questions? Do you have,
Yeah, get up to speed on it.
okay, do you have questions about what we just talked about?
Mhm.
Like the history of the annuity predates.
Upon a time.
Yeah.
Yeah.
Do you want to try the history of the
Once upon a
annuity,
time
or-
back in the 60s, they signed it.
Yeah.
It comes.
Yep.
Hey, you wanna?
Yeah, I'll
Start aside.
So the numbers we have here, the benefit values are here. What it really comes down to is we have a contract with Principal that we cut off part of it in 02. So anybody that retired before 02 has a guaranteed contract. Principal guarantees their payments for their life. And in exchange for that, we have to have certain assets inside of Principal. And the coverage that they need is based on these. There's a 10% plus this volatility factor. There's an interest rate component that comes into it, and that's what they figured it out. Marquette has figured it out, and that's why you see these two numbers. One's green and one is in black. The green one is theirs or ours.
It's ours.
Ours, and theirs is the black, so they're close, and that's kind of how we monitor to make sure we're kind of looking at apples to apples. I guess in a broad sense, why are we doing this? Why are we still here? And that's what I've been here 12 years and we've tried to explore getting out of this twice. And the answer has been, you can't. When we sign these contracts with the people, they guaranteed these for life and they're not gonna give that up easily.
So until
Yeah.
they die, we cannot get out of it.
Yeah.
Well, we can.
We
you
have to
could
buy them.
annuitize- we'd have to
We've never
annuitize-
approached, right? So
We'd have to annuitize the contract.
That's right. And the roughly value would be something about in one of these numbers down here. Roughly. Econ, our actuary, provides a little bit better kind of color on that about what kind of, in the end though, what we've worked with Marquette a lot with is to have just a number with 1, 2, 3, 4 investments, in here, just to pay benefits and to get good returns. So we picked the best ones that we wanted, which we've wanted the real estate.
Yep.
And then the one we have to have for payment. And then the other ones, that's why we use these ones with the 95 factors. The reason they do these factors is this is the volatility factor associated with the risk inside of these funds. And so the fixed income doesn't vary very much, so they give you 95 cents on the dollar.
How many people do we have drawing from the pension?
Total?
Yeah.
70 something. Associated with this specific contract is the numbers
Two
like
thousand two.
is like 10 or 11.
Yeah, okay.
Unfortunately for people that live here, that work here, they live a long time too. We've only had that number
them,
drop at
yeah.
just a handful since I've started.
Okay.
But
We were gonna get numbers to see, did they ever give us numbers to what the annuities contracts would look like?
No, we haven't gotten those yet.
Are they working on it or are we sort of, is it radio silence?
It's a little bit of radio silence.
Mhm.
from
uh,
principal,
No,
yeah. Well,
from,
I think we were gonna ask principal for the numbers.
yeah,
yeah, I've never.
which I think we should.
Did.
I think we
Mhm.
should and see what it looks like.
So the components that go into this are interest rates and the longevity of the people inside of that.
Expectancy.
Yeah, the actuarial life, the mortality table of these people. The strange thing, one thing I looked at, we went through this about a year and a half ago with the Monte Carlo, with talking with all these
Mhm.
folks. That number hasn't changed very much. As interest rates went up, so do these numbers. So the actuarially, every month these people get a little bit, actuarially closer to the end of the contract. But as interest rates go up during that time, then their actuarial value goes up. And so that number of the benefit value hasn't changed very much in 10 years.
But they're,
So that time period, interest rates going up, every month normally, you just kind of see the expected value of the future
Yeah.
outputs to go down just ever so slightly.
Yeah. And over 10 years, you'd expect it to you get to this little matching spot where we got a little extra money. We want to get out of this contract. We can get returned better somewhere else. But as the interest rates have went up over this last 4 or 5 years, that benefit value doesn't change.
But if we ever got to a point where it went up to like what it was in the late 70s, early 80s, actually early mid 80s, we should be able to get out of a contract, but I don't ever expect to see them.
well, the only way to get out of the contract is to annuitize or have the 11 people go away.
Right.
Right.
What I'm saying is if the interest rates go high enough, that means that the amount that you'd have to put in the contract is going to be less.
Appreciate that, but the contracts,
And so
you have to you have
Yeah.
to,
Right.
you have
So
to
You have to
create,
give them X amount of dollars.
the best thing I
Yeah.
think we could do now is get the number
yeah,
and compare that to what our actuary would estimate. And if they're close, then our actuary would be able to estimate this at about any given time. And then we
Right.
go back to principal with this amount of money and say, hey, can we get out of this thing with?
because what they're keeping in there is what is probably needed to, from what they said when we spoke to them, is what's needed to annuitize the
Mhm.
contract.
And they're not performing poorly. That's kind of the thing we
Right.
want, are they?
That's.
It would, yeah, but if you had freedom to do what you wanted to do, it would be.
Right. I don't like
nicer.
to have my hands tied, but at least
Right.
they're tied loosely. Sure.
But we need to see those numbers from principal to see what it looks like.
So you guys could have done them.
Because
Good. Either way.
if we
I'm
do that,
more than happy to
then-
answer any questions and more like an education piece on this broadly. It'd
Thank
be
you.
really nice if we just get rid of it and then no more education. No more sheets and no more
and we
calculations.
get rid of principal, because if we leave principal, they will annuitize the contracts automatically.
They'll keep paying the people and they've guaranteed them.
Yeah.
We then would also have to find somebody to administer the pension.
Well,
That's
we
easy.
need
benefit.
a paying agent. We need a paying
We
agent.
need to pay.
You could do that? You,
No, but then
No?
you could look at
yes.
all kinds of options.
Yeah, and we can find those people too.
Yeah.
Yep. Good. Anything else?
All right. Anything,
I move for adjournment.
oh, hang on a second. Does anybody have anything else? New business, old business?
The only other thing I would say is we did get the actuarial report.
Mhm.
It did have some good news. Our required contribution went down because investments were so good. And we are certainly able to have somebody from Econ AJ here in August to kind of go over that actuarial report if you desire.
Even though that it went, the contribution needed went down, I think we should discuss not reducing the contribution. Because then we're gonna get ourselves behind.
That's not our
I'm just
play.
saying that. Saying,
Yeah, we are
That's-
still putting forward, all of the
okay,
property tax money that we get.
Right. So one thing that really varies our plan is we put in what we collect. It has nothing to do with the actual arc.
Right.
It's whatever we get, we put in. If it's not enough, then it's just not enough. What really provided a really good coverage this time is we got out from, I remember how they would go down this thing, and when we ran out of money, they had this blended hybrid rate that they had to use once the principal, once the pension ran out of money. That was no longer, with the good investment returns, it became solvent over the life of everyone inside of the pension today. And so that discount rate went to 4%, which is that historical rate versus the municipal rate. So that helped out tremendously. It puts us in the 90%, 90% funded from 70 something. So that's very positive news on good
Mhm.
returns.
so our unfunded liability is only about 10% then?
That I don't know.
Yeah,
Yes,
Yeah.
if you want to look at it, yeah, that way.
yeah, correct.
That's gotta be.
You guys always got it just a little bit different than what it, but yeah, that is right.
Well, I mean, that's much better than what other municipalities have been dealing with.
That would only,
I'm just talking about it from a general standpoint. Correct.
They've improved the past handful of years,
but, Yeah.
not anything 90%.
It's great.
it's a good. I mean, it's in a way better shape than it was
Mhm.
because investment
Yeah.
returns. So good. But yeah, we'll have them here
But
in
no,
in
but
August.
what
and,
they
HA for-
contribute is above our pay grade. That's,
It's not above our pay.
It
We
is.
just can't make a decision.
We have no plan to bring to you any change in our contribution level.
Yes. Late contributions.
good. All right, anything else? Any questions?
I got a question. Is there any availability in the tax rate to increase the amount that goes, to increase either the tax rate or the amount that if we're getting the maximum amount that we're supposed to get, then obviously, but I'm saying, what if? Do we have the ability to increase? Okay,
I mean, you've got the ability to increase, but that's either a board vote or a
No,
I
that's a
know.
or
people
a
vote.
people vote.
It's
Is it
a
people
people
vote? Okay. That was my second thing. I was gonna say board vote or a people vote. So
I know people vote.
you will need to submit questions to Darren before each meeting now. And you have to approve them. Any other questions from anybody but Alan? Now you can motion to adjourn.
I don't want to anymore. I move that we adjourn the meeting.
I second. Meeting adjourned. All right. Thank you, gentlemen. Thank you, ladies and gentlemen.